the treasury. 1st of June, 4th. So now the topics which we are going to discuss. Once again, I'm just reminding you in the topic, the sequence here, this is the sequence what we are following. Money market, Forex, securities, derivatives, trade finance, hedging. Okay, so now the treasury payments, because you don't see the commodities here, but commodities in general, what I'm trying to do, I'm going to cover under derivatives only, commodities, because the futures and options are part of are the commodities. Okay, for better understanding what I'll do, I'm going to include the topic here is a commodities. Okay, so now, because see, under as part of the derivatives only, that should get covered. Okay, because it's a part of commodities are part of derivatives only. So now, once this will be completed, then we'll move on to the risk management. Okay, risk management, market risk analyzer, portfolio risk analyzer, credit risk analyzer. Once these three topics will be completed, then I will start the part 2 of the FSCM. Part 2 is a this, let's say this one is a part 1, part 2. So now the part 2 is a credit management, collections management, dispute management. Then if anyone needs still, what I'll do, the bill of direct, it's a web application and also it's a Java based script. Okay, I mean Java based developed application, but the overview I will give you. Okay, overview of biller direct. Or just it will take half an hour because I have some standard documentation. I'll explain. Then the last one is a BCM, bank communication. You may ask the question, one question, sir, why it is a BCM is a last? Because purposefully I have updated, because the people's majority of the batches, what I have noticed, as soon as once this treasury part will completed, no one was turning to the sessions. So that is the reason the important topic which I have updated is a last. So at least see, you can try to attend. Okay, if you are not feasible for this treasury, then you can prepare credit collection, dispute and some other topics also. Even there are many openings on these positions also, on these modules also. Don't ignore, because if you wanted to learn, okay, you can see in DCD, right, document credit decision, entire Google you can search. There is no video for document credit decision. You can see only my video, you can find it, you can able to see. Okay, so no one is explained about DCD, because the credit management, static credit, static and the dynamic. But what about the DCD and SKs? All the things, there are new things will be explained based on the real time only. So I would request you to people, please try to attend. Don't ignore these sessions also. Sometimes if worst case, if you will not able to crack the interview on these topics, then there is always will be available. It's a ready market is open. Okay, for these topics also. Okay, I'm requesting you people. Okay, don't ignore. And also, because you see, maybe bit, but I will give some more inputs, right? Some more for you. Okay, so now this is the sequence. So what we are going to follow. So now for this is the notes for cash and liquidity management. This is, you can see here, just a basic configuration I will leave. Then money market, forex, securities for each and everything. I'll add a separate sheet. Then we can continue. Okay. So now, since we have completed the cash and liquidity management. Okay, people, you may ask the one question, sir, why don't you start the first treasury? Then after that, you can also complete the cash and liquidity management. Now you can tell me, anyone, Until now, we have done the planning. Okay, the planning we have done based on the current day statements by creating the memo records. Okay, first what we have done, the planning how we have done. Okay, let's go back here. I'll put it here only. Okay, let's take one example here. Because why only cash and liquidity management is a first topic. Okay, so now what we have done, the planning with current day EBS statements. So this is the one what we have done. What we have done, we have created by creating the memo record. I'll put it here is a by creating the memo records. By memo records, we will come to okay, our cash manager. Cash manager will do the analysis. Point number one. Then the planning first one, what we have done. The second one, what we have done, liquidity forecast and okay, liquidity by implementing the liquidity management. Okay, liquidity items are nothing but your subledger or vendor FI transactions or vendor and customer. So by implementing this one, actual cash flow analysis can be done. The cash manager will do the actual cash flow. So by performing these two functions, cash and liquidity management, by performing these two functions, we will come to know our cash manager will do the cash forecast analysis. What will be the incomings? What will be the outgoings based on the date criteria? Then in case if he will find some excess cash in the bank accounts, in their bank accounts, so it's a well and good. In case if they will have some deficit funds in the bank account, then they will also try to borrow the funds from external sources or internal sources, whatever it may be. It depends on the feasibility. But now here, always most of the times the organization will try to achieve the goals, then they will have a sufficient operating capital, okay, or operational liquidity. So in this process, let's say the cash manager found, okay, let's say I'll put the point here like this. Okay, as part of cash and liquidity forecast analysis, cash manager found there is some excess liquidity. I'll put excess cash in excess cash. I'll put it. So now there is a excess cash. What the cash manager will do? Okay, his job is that he just need to do the analysis, then he need to communicate to the management people, okay, to the treasury department. Basically he need to communicate to the treasury department. Ultimately the final decision takers would be a treasury department people. Okay, so now as part of his analysis, now 10 lakhs, let's say the 10 lakhs rupees he found there is a excess cash, let's assume. So immediately he will communicate to the treasury department. The treasury department, what they will do? They will call to the accounts payable team. Okay, accounts receivable team. Okay, majority of the people will be there. They are the okay utilizers, because for accounts receivable team also would require. Why? Because see, by to generate the capital, okay, to in order to increase the sales department has to perform some additional activities by incurring the some additional expenses like advertisement activities, so sales promotion activities. Okay, for all these activities also there is a budget amount to be required. That is the reason accounts receivable team also should be present. Then accounts payable team also. Okay, so how long? Because whether you people will have the sufficient funds or not for future needs. Then once they will be discussing internally, once they will take a decision. Okay, so now this 10 lakhs rupees, let's assume, okay, until 6 months, let's say until 6 months of the period, until let's say until 2 years. Let me put it until 2 years, until 2 years, the excess cash, the excess cash will not be required, will not be required. So now what is the excess cash what we are having? We are having the 10 lakhs rupees is the excess cash. Now what they will do? Immediately the management will call to the treasury department. Then they will inform to we have excess cash. You can try to investigate what would be the maximum risk, what would be the risk and reward. And also the management will inform to treasury department, or treasury department also will do the forecasting like this. Okay, now I have the 10 lakhs in my 10 lakhs in my accounts. Okay, so now this is the capital which we are having, capital which I am having. Let's say the management is expecting the returns on investment, returns on investment. Let's say they are expecting the returns on this investment, let's say per annum. Okay, returns on investment per annum, I'll put it here is the yearly returns. I'll put straightforward here, so for clear understanding, yearly returns. So let's say they are expecting the yearly return is a, let's say the 12% per annum. Let's say that, okay, if they will go for the first, let us understand standard one. Let's say the 7 to 8%. Okay, so now 7% is the yearly return they are expecting. 7%, what would be the source? So now if I am expecting the decent return without taking any risk, is there any challenge or is there any risk if you notice here? Because in order to get the 7%, what are the instruments are there? What are the instruments? Instruments are nothing but what are the sources are available. Then in order to get this 7%, you have the bank fixed deposit. Fixed deposit it is there. Thanks, fixed deposit. If you go with this one, yearly you will get the 7% income. Okay, so now 70,000, let's assume 70,000 which you are getting. So here the basic point here is that what we need to understand, it's a risk criteria. We need to understand no risk. Okay, there will be a risk, or it's, I would say, the less risk. So if you deposit the money into the bank account, you don't expect anything until and unless if bank goes some bankruptcy, some fraud will happen at bank end. So here less risk, decent return. Then organization, the management is thinking that, okay, sir, I don't want this return because my expectation would be annually 12%. Annually 12%. Then let us take the, okay, I will put here is the option number 1, right? This, then second. Okay, so now let me put this one. Second. So now here what I am having is a option number option number 1. Okay, what I found, there is a fixed term deposit. It's a low risk with the less risk. So now let's say my requirement would be option number 2. I'll take the same example here. I'll take the same example. So now option number 2. So management will say, no, the return would be, I don't want to expect this 7% of the return. This is not as per my expectation. My expectation would be, let's say the 12%. 12%. So now we will get annually 1,20,000 rupees. So now what is the source? You need to understand here the source. Bank fixed deposit here is a FD. But here is the, let's say the management is thinking that banks will never ever give 12%. This is a known fact. But now what are the other sources are there? Let's say I'll go for the mutual funds investment. Mutual funds investment. So mutual funds, I can expect the decent return, but I would not say low risk. Yes, it is a risk factor, because if you closely observe, if there is an advertisement from the mutual funds, always there is a sentence. The risk, these mutual funds investments are the subject to market risk. Subject to market risk. So why the subject to market risk? So because it is depends on the market conditions. The returns will be depends on the market conditions. Again, if you want to, there will be a different kind of funds will be there, diversified funds and also capital large, okay, the sectors, there might be different things are there. Okay, so now you just then, but now the decent return which I am expecting 12%. Okay, so some funds are giving even 28, 30% also returns. Okay, so now this year, I think last year in 2024, then there is a one Tata. Okay, they have given the return around 24 to 26%. Exactly, I don't remember that percentage, but now it's a good return. But now you can see I am expecting 12%. I don't want even beyond this one. Okay, if it is a beyond this one, that is also well and good. But my expectation would be 12%. Even though if pandemic situation, if you remember, even the 12% also it was not expected, because even the funds, whatever you have invested, it was going down. This in its principal amount also it was reducing, because don't forget about the return. So because of the external situations, this is that there is a less risk, I would say the low risk here it is there. So let's say here the management is expected 12%. Let's say my requirement would be, again management will say like this, no, even I don't want to go with the 12%, also not satisfied. The management or the organization people did not satisfied. My expectation would be, my yearly expectation would be 30%. Let's say the 30%. Now the 3 lakhs, what you are expecting return on your investment. So here the management need to take a decision. It's a high risk. High risk it will be there. So here we talked about mutual funds, but now what would be my best instrument in order to give the 30% of the return on my investment? So now if 30% of the return you will have it, then this instrument again will come into picture. Either you want to invest into some stocks or some bonds, or it's a commodities where you want to invest, or futures and options where you want to invest in order to return 30%. But you need to think about this one, because this is the high risk, and also I'll put it high return. high return will be there. High risk and high return. Here I would say the medium risk and medium return. Medium return will be there. So here low risk, here I would say instead of low, okay, less risk or low only, okay. Low risk, less return. Less return. You can see the scenarios here. What would be your expectation? Based on the expectation, you need to identify the instrument. Okay, so now here mutual funds will not give, I'm sure 30% will not give the return here. Okay, so now the investment which I am going to choose is a, let's say the IPO, whatever you want. Let's say the commodities. You can see past 4 months onwards, the gold it is increasing drastically. If you remember in the month of February, the rate was around 61,000, 62,000. It is there now. It is closely 72,000. It has been increased around more than 12 to 15%. Okay, even silver also, it was running around 60,000, 65 something, but now it is crossed 90,000. You can think about commodities. So now I'm trying to invest the amount, this 10 lakhs excess cash into the commodities. But commodities, is there any guarantee here? See, is there any guarantee? Is there any prediction? You are expecting, you are investing 10 lakhs rupees. But now your assumption would be, if the market, if the price go up, obviously you will get the return, your expected return. But now, in case if it will go down, what would be your risk? How much risk you are going to bear? Because 10 lakhs you are expecting today, the price is some 70,000 gold, let's assume. Tomorrow it may go to 60,000 also. I mean, after 1 year of the time, you don't expect, right? The prediction. So you need to ready to take the risk. That is the reason high risk, high return will be there. So if you are taking the risk, maybe this entire amount also will be wiped up because of the market situation. You don't know, right? So you need to take risk ready here. That is the one option number 3 here. That then the treasury will come into picture. Why I have explained all these options? By before implementing all these instruments, or before taking a decision, by doing investment, all these things, either less return, whatever, medium return, high risk and high return, the treasury function is going to help you to do the investigation, to do the analysis before going to take any decision on investments. Okay, now you have decided that you want to invest into the mutual funds, but you cannot directly go and invest, right? Which mutual fund is a good one, and who is the fund manager, and where they are investing the funds? Again, the mutual funds also, they are investing into equities or different things. But again, you need to do the investigation. Past years, what was the background of fund manager? Okay, how much the maximum returns? Okay, in case are there any negative impacts? You need to think that treasury will give the information analysis. Okay, so based on the analysis, you need to take a decision which instrument is feasible for you. If you are ready to take high risk, you can go anyone. Equities, commodities, or I'll put it here, commodities or equities. Commodities or equities. Which one is feasible for you? You can go. Okay, or futures and option, whatever you want. Commodities, the futures and options, it's part of commodities. Now, if you are medium risk, then you can go. But before going to do the investment, you must have to take a decision. This is only one scenario we have seen. Let's say I have already done the investment past 5 years back. Today I want to do what would be the my current value of that investment. Either the price been increased, either price fluctuations. Then you can also do the forecast analysis. I mean, not forecast analysis, actual analysis based on the actual data. This is where the treasury will come into picture. So now, so not only for the risks, here the main thing is that risk, how much risk you are ready to take. Okay. And also then here in this process, interest rate risks, interest rate risks will come into picture, interest rate risk, then commodity risk will come, and also exchange currency risk here. This is only we discussed about in Indian rupees. But now currency risk also will come into picture. The currency risk in the sense, now today the dollar rate is 83 rupees. Maybe after 1 year, what would be the rate? We don't know. So now you need to take a decision on that one also. So again, the treasury will come into picture. How you need to manage the currency risks, how you can protect your organization, how you can mitigate your risk. This is where the treasury will come into picture. Okay, this is just an overview of the treasury, because if you have the sufficient funds, then this will come into picture, then treasury. Okay, so now that is the reason being that initially the topic which I have covered is a cash and liquidity management. That is the reason behind that to completed the topic, the cash and liquidity management. Okay. So now there are few basic configuration steps, around 26 or 27 configuration steps to be done. Then each and every step is a very important for us. Then from tomorrow onwards, I just have given an overview of this one. Then in the next session, I will start the basic configuration of the treasury. See, basic configuration of the TRM. Okay, then I will start the money market. The first topic would be a money market once the basic configuration. Because
Hello,
if you
Vijay.
want to post, yes, tell me.
I would like to mention here, I don't know if the other notice or not, but the way you have started explaining the treasury and before it you have given this overview is really very nice. Because I understand this, I understand that who can make understand like this, you know. It's really nice when you have started this. Thank you
Thank
for
you.
it.
Thank you. Yeah, thank you. Thank you. Thanks for your feedback. Because see, there should be a reason, because whatever we are doing without correlating the topics or correlating the objects, it's not the fruitful. My intention is that because whatever I know the subject, I have to put in front of you. Even a single also, even 0.1% also, I'm not hiding anything, because whatever I know, I'm just presenting in front of you people.
Vijay,
Okay,
just I would like to add something. Yeah,
please.
yeah, because this is earlier also joined in another tutor for
Mm-hmm,
FSCM,
mm-hmm.
but that was not good. Okay, because no explanation, nothing. So just whatever, just executing and showing. But you are like helping group very much. Thank you so much. Yeah.
Yeah, thank you, Patesh. Because
Yes,
see,
without saying that you are explaining a treasury and you have started, explaining and then correlated in the treasury. The people who have not worked in the treasury, they will not understand this value of 15 minutes what you have spent. But I know this because I am working in it. So really nice you have started and you have correlated it. Keep going like this, sir. Thank you.
okay, yeah, thank you, thanks for the feedback. Okay, okay, okay. So now we'll continue from tomorrow. Okay, yeah, thank you. Yeah. So if anyone need any, I mean, any errors kind of thing, please reach out to me. So maybe one thing, 1 second.